Good morning, everybody. Welcome back to Schwab Coaching. It's our St. Patrick's Day edition of Trader Talk in today's market. And I'm your host, Kevin Horner. I'm joining you from Denver, Colorado. Today, I'm pleased to be joined by Schwab Regional Investment Strategist, Rachel Dashiell. Good morning, Rachel. How are you today?
Good morning. Happy St. Patty's Day. Looks like we're both going to get pinched today.
Yeah. Coming a little ill-prepared with my dress today. I apologize for no green. But you know what? Maybe we've got a little, do we have a little green on the screen on from Friday following into Monday? Perhaps we've got that. We'll take a look at that with everybody, as we often do, of course. But great to have you back, Rachel. Everyone, say good morning and hello to our friend Connie Hill in chat today. She's going to keep an eye on things for us there. Of course, Rachel and I will certainly refer to your comments and questions in the Q&A. Please feel free to post in there for the duration of our segment. We do go about 45 minutes in total. Now let's get to some disclosure detail, and then we'll quickly get to the charts of the market. So as always, we want to remind you that our conversations here are exclusively informational and educational. We do not make recommendations nor endorsements for a particular approach or strategy to trading the market. We also talk technical analysis here quite a bit. Remember, the extent to which we do so, technical analysis should be considered complementary in nature to your fundamental research. We do not encourage you to utilize technical analysis as the sole means of your research, just one piece of the very large puzzle there, everybody. Of course, we have to remind you of our agenda as well. You know, we start here with a top-down approach to the market. We try to look at the major indices to get understanding of maybe some leadership in the market. We're going to look at the S&P 500 as usual. We'll look at the NASDAQ 100 as well, the Russell 2000, semiconductors, and so on as we work down our groupings, sectors, industry groups, individual equities as well. So plenty to get to this morning. We're going to kick it off with the S&P 500. Rachel, great candle day on Friday. How about broad thoughts as it relates to what's been a pretty good pullback, a retracement of better than 10% in the S&P 500? Could Friday be the beginning of something for us?
Yeah, so let's just kind of start there. So first and foremost, we've had a 10% correction already so far, and that's kind of what we coined the term as a quote-unquote correction, is that 10% pullback here. We can see in the short term, we are below all of the moving averages. So you have, I think, the 10-day, the 50-day, and even the 200-day, we're still below all of those. So the short-term trend is down for the time being, but we did have that little bounce on Friday, like you mentioned, and we also got oversold in momentum too. So we're seeing a little bit of bounce from there, maybe a little bit of a washout here at the bottom. But our really first level of resistance that we're seeing is that 200-day. So bulls are going to be looking for us to reclaim that first and foremost.
I think you're right. Of course, we can get a bounce and things could play out favorably for a few days. One of the things that I sent on X last week was just a reminder that everything starts from one small step forward. That first step for a lot of traders was Friday's close being above the high trade from Thursday. That's because Thursday's price action gave us the lowest trade in this pullback. So if that is going to be the low, the place we could begin first would be on a close above the high of our low day. And that certainly played out Friday. So some of you may have utilized Friday's afternoon session, the close of the segment there, to validate or get started potentially in a relief bounce move to the upside. But Rachel, it's unclear right just yet, of course, whether what we're looking at is a relief bounce or the beginning of getting right back in gear with the bull market we've been witnessing for the better part of the last 2 years. And for many traders, Rachel, it's just too early to tell.
Yeah, it's definitely a mix of factors. I know that the setup is there as far as what we're seeing, some washout levels in market breadth occurring. So we're seeing not too many stocks participating really in this initial move, at least quite yet. We're seeing some seasonal factors, the seasonal lull that we've been in, and then we've had some extreme bearish sentiment as well. So kind of taking a mix of all of those factors. Typically, the setup is there as far as just finding those contrarian signals and finding some of those bullish opportunities. But again, time will tell, and we'll have to see if some of those areas improve from here.
Now, Rachel, you shared with me a seasonality chart this morning that I thought we could bring up here because I think it tells us a little bit about maybe how we can get a little lost in our understanding of market returns. Can you speak to us a little bit about what you've sent here in the chart? We're looking at essentially the S&P 500 here as it relates to historical price pattern throughout the year, correct?
Of course. So this is just a seasonality chart. I think we have SPY up there on this one, Kevin. So I'm not sure if we're looking at SPY or SPX in this.
Let's change it.
Just in case. So
there we go.
There we go.
My fault. That's on me. There you go. Go ahead. So there's our 50-year average of the S&P annual performance versus what we've seen thus far, right? So take us through this and maybe the thought process that some traders are considering.
Of course. So seasonality is no trading strategy or investing strategy in itself, but it's definitely something to be mindful of. So we've seen, just using the red line there, we've seen over the last 50 years, it's an average of the S&P 500 annual performance. So the seasonal lulls tend to really occur starting around March timeframes, and then again in like September and October. So comparing that to this year so far, which is that blue line of the 2025 performance, we've seen seasonality is pretty much tracked day for day. We made highs on almost the same day mid-February, and then we just saw that we made the same level of lows really late last week when looking at performance. So seasonally, we're in store for a little bit of a bounce, but like I mentioned before, it's no trading or investing strategy in itself. What we want to kind of pay attention to is when price doesn't follow these seasonal trends, that could be more of the warning signal or signal that there's something else possibly going on here.
That is a wonderful call out, Rachel. And I didn't realize the consistency of those dates as you called it out, too. You're right on the money. The peak this year happened to coincide with the traditional historical 50-year peak in February. That is just crazy. And then this week's bounce, the bounce we started on Friday, we're one day off of it, it looks like. That is incredible consistency. Now, obviously, we don't know that what we've got playing out now is going to finish the way the red line presents. That would be an amazing development for the rest of 2025, of course. But I think what it illustrates more than anything else is the immense volatility that we are undergoing in the last 6 weeks, 4 to 6 weeks or so, probably closer to 4, excuse me. And that, hey, it's a little bit out of character regardless of whether you were prepared for seasonal weakness, right? So I think anyone who was prepared for seasonal weakness probably saw that weakness extend beyond their expectations or their comfort, perhaps even in many cases. That's a pretty good chart, Rach. I always appreciate it when you bring us some great detail like that. And the last one you brought us was the NYSE highs and lows and positions over major moving averages. So always some great context to provide for us there. Now, last thing I wanted to discuss here was something that I mentioned on X last week, everybody. And it's just the difference maybe between the 20-day moving average in orange and a 10-day moving average that I'm going to change to here briefly. So I'm just going to eliminate my stair steps along the way there. We could point out the fact that we are up nicely on the SPYs here today, or the SPX, excuse me, about 0.4%, moving through the highs we created over the last 4 sessions. So a nice positive start to the day. But a lot of traders are probably monitoring that 10-day moving average for an indication of whether the downtrend may come to a close here in the near term. And why that might be the case, if it doesn't look like it's stuck with my 10. Sorry, everybody. I'm going to change my 20 to a 10. And let's just update that color real quickly here. So look at where this 10-day resides, everyone. We are almost right back to it. So the 10-day comes in at 56.74. And that's a pretty important level, Rachel. We've been below it since the 19th of February. And if you're a trader and you see this, you're looking for something different, right? You want to see us move through that 10-day, ideally with some conviction that could give bulls a little enthusiasm here, potentially in the first hour of trading today.
Yeah, and a lot of traders, I mean, if we're looking for confirmation, we're looking for a move above that. We're not just looking for a strong intraday move. We're looking for at least a close above that 10-day and maybe a couple closes beyond that 10-day as well. I know, Kevin, you have your Horner rule as far as I think it's 3 closes above that moving average. So some traders may be looking for that, just some consecutive closes above that 10-day, or even a percentage filter or percentage move beyond that 10-day moving average too, whether that's 1 or 2% above that move.
You're on the money there, Rachel. That so-called Horner rule does look for 3 closes above support or above resistance to validate a breakout, 3 closes below support to validate a breakdown. But I'll point out that while that is a rule of 3 closes for the so-called Horner rule, really what matters is that you as a trader or an investor alike, you have a plan that says this is my confirmation. For some traders, it's 1 day. For some others, it's 5 days. You want to be a little more conservative versus a little more aggressive. Whatever your level of comfort is, that's what you want to make note of and then work to stick to that. So more than anything, it's just it's a rule about having a plan and sticking to it as much as anything else, everybody. So yeah, let's see if we can move through the 10-day. The close over the 10-day would be a wonderful development for short-term bulls and could certainly give us the target about 80 additional points higher at the 200-day moving average, around 57.40 at this point. So keep an eye on the 10-day. One thing that a lot of traders will do, everybody, is you'll take the value of the major moving average that you're monitoring on a daily chart. That's, again, 56.74. Maybe you move into your 5-minute bars, put a line at 56.74. And just give yourself something to watch, right? And see how the market acts at that level. I like to cheat and just write it in so I never have to, use my eyeballs to determine where I'm going to place that line. I'm just going to place it right at 56.74. And you know what? You just got to look at the fact that there's a little bit of history there at that ledge. If I went back to make this 10 days and extend it, let me see if I can extend this to the left. Yeah, there was a little ledge there. We bounced against it. So yeah, we need that level at 56.74, but you short-term intraday traders might do something like that to monitor. Now, Rachel, of course, I mentioned and called out your breadth chart, and of course, we've got some intriguing requests, so let's go ahead and bring it over. Why not? And then we'll move over to the NDX, everybody. But here's that chart we were mentioning, giving you a view of stocks in the S&P 500 over their 50-day moving averages, over their 200-day moving averages, but also stocks making new highs and new lows. Rachel, is there anything specific you're taking from this grid here? And before I wrap it and toss it to you, I'm just going to let everybody know I'm sharing this grid with you all in the chat here. So just as a heads up, you'll have that opportunity. So, all right, Rachel, what are your thoughts when you're looking at the breadth grid we've got working here? Oops, bring that back for you. There you go.
So the first couple of things that I noticed here, so when we're looking at the majority of stocks, or the minority of stocks in this case that are above their 200-day moving average, 50-day moving average, we're seeing that we're falling under the minority of stocks being above their 200-day and 50-day. So we're still, I would say, in a little bit of a correction territory, weak breadth territory here, because the percentage of S&P 500 stocks above their 200-day is about 40%, so still about 10% below that level. And we have even weaker breadth in the shorter term with the 50-day moving average. Something else I notice is we're not having an increase in stocks making new yearly highs yet, which makes sense since we're in the middle of a bit of a correction here. But the main thing I think about this chart that stands out to me is at the bottom there. We're seeing actually the NYSE new yearly lows hit all-time lows after peaking beginning of March or so, and now we're hitting those record low levels. So it could be a little bit of a signal that stocks stop going down, at least for the near term, but that's kind of the main thing that I'm noticing here. Do you notice anything else, Kevin?
Yeah, honestly, you caught it. You caught the same thing I did. That was the takeaway for me, is that we are at stocks making new yearly lows. It's as low as we have seen since the peak, basically. So, and here we are in price action at a level that some would tell you is a appropriate support zone or appropriate spot to deploy new funds potentially. So yeah, I take that as a potential signal, much like you, that it could be validating a turning point here. But again, as usual, we're not going to get ahead of ourselves. We're going to let price action kind of dictate our process, I hope. And let's see if we can't fix the trends from the price action standpoint and not concern ourselves with as much of the tertiary details, as is often the case, Rachel. It's in these instances where that uncertainty comes into the marketplace, and we're looking at these pullbacks and trying to define them as, all right, standard versus a bit more aggressive in a pullback. Maybe we have a breakdown, etc. We always start to parse every single piece of data we can to validate our viewpoint, where usually that just means we're looking for validating our biases, and that's something we got to stay away from if we can. I mean, that's a really hard thing to do as traders, of course, to ignore those inherent biases that we maintain. But it's really incumbent and important for us to do that, isn't it?
Definitely. And I think when we talk about staying away from biases, can you do me one more favor, Kevin, and maybe just zoom out to a 3-year time frame instead of a 1 year? Because I think it'll put the current breadth levels into perspective just a little bit more, and just kind of show where we're at compared to what we've seen in larger corrections, or even where we were at in the bear market of 2022 as well. So we're still in decent territory. We're not at any of those extreme levels in breadth participation or lack of breadth participation as well. So I think even just zooming out to some of those more historical levels, comparing what the correction is now that we're seeing in the market compared to corrections that we've seen over the last couple of years, really help put it into context a little bit more.
I totally agree. Great decision to kind of pan back and show a little longer term viewpoint there as well. Interesting stuff. So we're sitting at about 40% of the S&P 500 over their 200-day, and almost a little more than 36% over the 50-day. That kind of stands out again. I mean, that 50-day, it's nice to see that we've made a bit of a bounce off of that low we saw at the beginning of the year. As it turns out, we've seen a pretty decent improvement over the last few months there. So, it just maybe seems to imply a little bit more broadening of what we've seen, instead of exclusive Mag 7 leadership perhaps as well. So let's move on into the NASDAQ 100, Rachel. Let's see how we're doing here. We're up about 1/3%. Very similar looking chart. Look at that tail, Rachel. The 10-day moving average here on the NASDAQ 100 is at 19,834. Today's high, 19,833 and change. So yeah, what a spot to take a little breather here in the first 30 of trading.
Yeah, it looks a little similar to the last one we looked at of the S&P 500 as well, and we do have a little upper wick so far just in the first few minutes of trading, like what you mentioned. So, and we even saw a little momentum bounce as well, with RSI becoming oversold and then giving a little bit of a hook up from that level, especially last week. So this could definitely be one of those areas that the bulls are trying to push price action right above, is that 10-day moving average. But again, we have to wait for that confirmation to actually see a trend change, because the slope of the moving averages is still down. Price action has still shown a lot of momentum moving down. So we will have to wait for that confirmation there.
Yeah, I think we will, if you're looking for a little bit more confidence in the bounce. Rachel, what about the standpoint that says, hey, we've got the NASDAQ and the S&P finally kind of mirroring one another again. Do we traders take a little more confidence in that? Is it maybe make the market a little bit more easy to manage when things are moving in concert like this?
I think a lot of traders do tend to look for that because we've talked before, taking it back to really the old principles of Dow theory, where the averages must confirm each other. And a lot of traders will look for arbitrage opportunities if the averages don't confirm each other. So if one of them is moving up while the other one is moving down, where they've seen that that could be a signal to a possible pullback or a possible change in trend. And now we're really seeing those two move in concert with each other, like what you mentioned. So this could be a signal here for the overall market.
Potentially. So let's see if we can't get above that high we've made today. 17,833 approximately. Get through that 10-day moving average. We'll be feeling a little bit more inclined for some optimism, perhaps, but a bit of a ways to go here, everybody, thus far. Now, of course, when we kick it over to small caps, things are going to look a bit different, everyone, as you know. The nice thing is we're at the 10-day moving average, or maybe even right moving through it here this morning, Rachel. So we've seen, again, consistency in the selling amongst the major indices here, but a nicely improving look of the Russell as we are already through that 10-day moving average.
Yeah, this one, we've had a couple bounces of support here, it looks like. And then it looks like the Russell is ahead of the curve with the NASDAQ and the S&P here. So, because we're actually moving through that 10-day, like you said, Kevin. So maybe the Russell here is, in this sense, a little bit of a leading indicator to the other two. We'll have to see. But the interesting thing is the Russell is still in a little bit of a longer term box pattern too, despite this move off of that longer term support. So I know we always like zooming out a little bit as well. So if we look at even like a 5-year, 3-year, we can see we're in still a little bit of a rectangular pattern below those former all-time highs, but maybe this is this new low that we're placing in, this new higher low within the context of a longer-term uptrend.
That is I somehow managed to forget about the importance of this ledge at about 2,000 on the RUT here, Rachel. I got to say, that's a pretty interesting spot when you think about it from the standpoint of, hitting our head on the ceiling here a number of times. And it took us a while to get through it, but all we've done is just kind of retest that level here. I was just looking at all of this back and forth price action, and here we are last week with a fantastic, as it turns out, a fantastic hammer candle for the week, holding the 100-week moving average. That's a very long range moving average that the Russell had been above since late 2023 here. So that actually is a pretty intriguing development. And if we were just talking about it from the standpoint of the candle patterns and looking at it on the weekly here, if we can just move this week through the high we made last week at 2058, excuse me. So if we can move through 2058 on the Russell and keep above it at the close of the week, that could be a nice development for the small caps here. So yeah, is it not really a shock, Rachel, that the group leading at this point is the one that broke down first too, right? We noted the struggle of small caps. We've been talking about it. The time frame of the true breakdown coincided with the rest of the market, basically February 19. But there's a big difference here. The S&P 500, the NASDAQ 100 were still at highs when they broke down. The Russell, by the time it broke down, was already off about, let's see what this number says, off about 7% when it started to fall. So, Rachel, is it at all a shock that the Russell would be maybe the leading indicator, the first real indice to move, because it was the first one to break down?
I don't think that's a shock at all. I think it's a little bit of a signal that we just discovered here that it is acting a little bit as a leading indicator, and maybe that speaks to some of the rotation that's happening in the market. So maybe the rotation happened out of small caps first, and then then large caps, and then now back into small caps. And that's just kind of what we see as far as what happens in the nature of bull markets, is we see that rotation taking place, and we see some groups forming leadership or relative strength before others. So I think you're right on the money there, Kevin.
Hey, I'll take that. You know what they told me a long time ago when I got married, when you get the answer you're looking for, you just take it and run. So I got what I was looking for, confirmation of the viewpoint. Thanks, Rachel. That's perfect. Now, there's a couple of questions in the chat that I thought we should bring up, and I think these are perfectly appropriate. We're going to continue to look at charts, obviously, but Keith asked a question about the so-called tariff speak out of the administration, Musk's market bombs, so to speak. How do we price in the potential for market shocks here? I certainly think it's different. I'm happy to provide a little context, but I'd love to hear your view on maybe managing the risk factors that are associated with simply headlines.
Yeah, so especially with headlines, anytime we have anything coming out in the news, the market has been a little bit reactionary to that. And I would say, and you can give your viewpoint as well, Kevin, but like we mentioned before, really sticking with your plan. If you are feeling a little bit uneasy about some things going into the market, maybe you have too much risk or capital at stake. So maybe taking a little bit risk off the table and rotating that into some other areas that are either a little bit more like cash or conservative, or a little bit more of a defensive in nature to really balance out your portfolio. I know that's some things that I talk to clients about on a daily basis, but ultimately putting out the noise, the fears aside, and sticking with your hard and fast rules and your hard and fast plan. So what are your thoughts though, Kevin?
Well, you're speaking my language, of course, Rachel. I mean, you're talking about management, trade management, and comfort with deployment of dollars. For a lot of traders, that comfort comes from staring at a balance of cash in the account and recognizing that that is their true risk. Well, if the positions that I'm owning go down X percentage, I've still got all this cash. That's giving me comfort. If you find yourself in a similar boat, well, I'm going to encourage smaller position sizes, because smaller position sizes lead us to greater comfort in managing risk. Often, if you find yourself struggling to deal with the market machinations we've had over the last 3+ weeks, well, chances are you might find yourself a little bit more invested than you are comfortable with. We often find our comfort zones in our true comfort for risk is found in the worst periods of the market. We always feel like, oh, I can sustain that. You know, if a financial consultant said, what is your tolerance for risk? We tend to state that we are more comfortable with risk than we really are. And then we get into the moment, the market is moving against us, and suddenly our tolerance for risk is much less. And it's because of things like headlines. So I'm of the belief that if you're really tethered to the headlines and you're concerned, the best approach you can do is tighten up the purse strings. It doesn't mean you liquidate your portfolio. It just means you reduce position size to levels you can manage and sustain, and take opportunities where they present themselves, but keep them small. The truth of the matter is, and I think somebody already said it, when the question was essentially, how do we price in these potential shocks to the system from a tweet out of the administration or other headlines? And someone replied, Paul replied, you can't. And I agree, you cannot. The only thing we can do is manage our positions properly and make certain that we are going to be comfortable with whatever potential market shock could come. So recognize that. Be a little bit more disciplined, be a little bit more diligent in your process. I think we can all benefit from that approach to kind of handling things here with this existing administration, because apparently it's going to be a little bit more of the same in terms of tweets and commentary. So, okay, hope that helped everybody. I'm looking, some of you might employ other strategies and whatnot. Certainly other ways to go about it, but like I say, positioning and proper position sizing probably has a lot to do with it. Rachel, let's move off of the large, small, and large caps and small caps. Let's check out the semiconductors. This was a group obviously we've been talking quite a bit about, but Friday I put this tweet out because on the daily chart it looks like a lot of mess, right? Where we know some levels we've struggled at. We're below all the major moving averages. We are above the 10-day at this point, but it was the weekly chart that really called out to me last week as evidence of a potential bounce spot. Look at that hammer candle for the week, right off of that exact same support that we tested back in August of last year. That was the carry trade breakdown. And then prior to that, April of last year. So we have tested this ledge. If nothing else, perhaps semiconductor long side, indices side, they can say, you know what, I'm going to stick with it as long as we hold that green line down there, because a break below that would, in fact, be significant.
Yeah, I mean, we're seeing a few hammer candles out there, which we know that hammer candles are typically those reversal candlesticks that occur at bottoms where we have that long lower wick, the open, the close, or near the upside of the candle too. So we definitely saw the bulls step in pretty strong there with a lot of demand if they're going to push the closing price of that candlestick all the way up near the high of the candle. So the market's really shown the importance of that level. We've seen a little bit of a bounce here, trading higher after that. So, and I mean, to add on to that too, I think that's the 100-week moving average or so that we traded below intra-week, but then yet closed above it still. So if we can still get another close above that as well with that upward sloping line, it's still showing that the overall long-term trend is still up.
Yeah, and I think what I just stated about the Russell leading us lower, the truth could probably be that could be applied here to the SOX too, because this has been a major consolidation period. It could be still be termed, right? Because ultimately, I mean, if we just look at the highs and the lows we've made since July of last year, we see that we've gone just that range, right? It's just been rangy. So upside to 5,400, downside to 4,300. That is a pretty wide range, I'll admit, about a 25% range in terms of the price action. But it does give us some levels to consider as it relates to a major group. And I'll just remind you, everybody, we have to undergo consolidations after significant moves to the upside. And just for the heck of it, because everybody knows I like drawing Fibonacci lines. Let's just see if this level that we hit, this green line, I wonder if it coincides with any standard pullback levels from the big move, which again was October of 22. Remember, 22 was, for the first 9.5 months, a rough year. And then things shifted. So if we just take a look, we basically got below the 38% retracement of the entire push to the upside. So we gave back 38% and we are back up above it. So starting to reflect that maybe everything we've seen in the last year plus is just a standard digestion of the incredible push that the semiconductor space made in that window of time. Rachel, your thoughts?
I think that's what I'm seeing as well. And I know for those of you that haven't used Fibonacci retracements, that's where those traders will use those levels as far as support and resistance. That's where they may place their stops as well, or their profit taking orders. So for anyone that was long during the bull run that we saw the last couple, I guess in 2024, it took out anyone that was possibly that had exposure to that space, took out their stops, and then rallied higher from there, has done it a couple times since then. So I think it's interesting that all those levels occur kind of right around the same level. The 100-week moving average, the 38.2% retracement level, the hammer candle really stepping in here. But we've, like you said, Kevin, price needs to correct either through price itself or through time, and we're seeing it do a little bit of both. But typically when we see these rectangular patterns, these trading box ranges, it's typically more of a time correction where we just need to take a breather after the marathon we just ran.
Yeah, I think in context, it stands out that it looks much more standardized now, right? With a little bit of height to our viewpoint provides a little more context. And the fact that we've tested that same level more than twice, now 3 times, and moved off of it might be giving bulls a little bit of confidence here as it relates to the SOX. So kind of an interesting development here potentially. Certainly bears watching. No one's suggesting you're so-called out of the woods, but again, with a little more color, a little more context, things might make a little bit more sense or maybe give us a little bit more comfort. Noticed a couple other things. First of all, I just got to say, everybody, you guys, our community here on the YouTube channel is fantastic, and I couldn't love it any more than I already do. You all are out here encouraging and reminding each other about what else is coming. You're absolutely right, Villager. We got Jeff's World on deck. We're going to hear the international discussion from Jeff. So absolutely make sure that you're on deck for that one, everybody. That is top of the hour at 11 a.m. Eastern, so check that out. We'll have Connie a little later today working with ETFs, and you guys are all encouraging each other, reminding each other about what we've got coming for you. So lots of opportunity to keep the education rolling here. Rachel, there was also one other thing you and I spoke about pre-show as it related to the broader market. One thing we noted last week was the all-time high close in gold. And I thought we could just quickly look at this briefly just to point out that gold continues higher. We're not going to talk about it from a trading standpoint, but it's notable that gold continues. I mean, this is the first time we've seen it over 3,000 an ounce. That's a big deal. But Rachel, this still is on the table, very likely as a potential flight to safety for a lot of traders and investors alike.
Yeah, it's interesting that gold is hitting new all-time highs, hitting 3,000 for the first time. And this is happening, like what you mentioned, at the same time that we're having a little bit of a pullback, a correction in the major market indices. And so it has been historically that flight to safety with long-term investors. But even just zooming out on this too, looking at a max time frame, we saw this entire bull run throughout the S&P, the NASDAQ making new all-time highs over the last few months. We've seen gold has really done the same thing. So, and that's kind of interesting to me. So it's not just in this pullback that we've seen this flight to safety. There has been a strong move consistently after that couple year range that we saw in gold, where we've made pretty structural stair steps higher, a structural uptrend there where we made higher highs, higher lows, and we are far above all of those moving averages. So we've had a lot of momentum here in the gold space.
Yeah, we sure have. And if there's any other takeaway for me, Rachel, it's the break of resistance with the white line that I put on here, and then the trending thereafter, following a standard technical analysis basic viewpoint, right? You break resistance and then you begin trending thereafter. And that's what we've seen. Higher highs, pull back to moving average, higher high, pull back to moving average, higher high. Perhaps the next opportunity is a pullback to a moving average. So we'll continue to keep an eye on that one. But that was a pretty notable development that happened early in 2024. And as you said, right in the face of the market, the S&P continuing its ascent and gold going with it. Kind of intriguing as well. Now, there were a few other things to get to today. We had some stocks in the news that I wanted to hit on in our final few moments here. I wanted to pull up just a couple of them. One of them was Netflix, which got upgraded today. Let's go ahead and put that in the chart. Netflix was upgraded by MoffettNathanson. Let me put a standard set of moving averages in there for us, Rachel. So we're looking at the 20, the 50, the 200. Looks like we're right back to the confluence there of the 20 and the 50 day. But Netflix upgraded to buy from neutral, new target here at 1,100 a share, which was up from 850 a share previously. So your thoughts on the pattern here, maybe what we're seeing from a technical standpoint, Rachel?
So I'm seeing a little bit of a triangular type pattern. So we've seen, since we've made all-time highs there around 1,064, we've had a little bit of a short-term downtrend, but each time we've rallied into that with a little bit of an additional high there. So The levels that I'm looking at, if you connect that all-time high down to that failed rally into the orange moving average, yep, right there.
Something like that.
Yep, and then connecting the lows that we've seen. So the low in beginning of 2025 and the low that we just saw here last week or so. So looks like it's a little bit of a coiling pattern, a little bit of an indecision, but in the long term, it still looks like a structural uptrend because we made a higher low. So we're not making lower lows quite yet.
Yeah, I agree. It might be a little tricky to discern immediate price action on a daily chart, but if you once more pair back to the weekly, you can see the action perhaps is all tied to the movement back up above the 20-week moving average in this light blue that we have accomplished at least today at the open. We'll see if that holds for the week. But for some traders, that might give you the level to monitor. And if I lift those lines once more, just take a look at where today's low coincides. And it happens to have been those prior highs. And prior highs, former resistance, now potential support. Some traders will tell you they like the fact that we've gapped the way that we have. And then other traders will say that gap's all well and good, Kev, but only if that 20-day, if we close above the 20-day, am I going to feel better? So, depending on which side of the fence you fall, you could be a little bit dubious about our opportunity here, but you also could be maybe setting up a trade to the long side if you are more optimistic and think that we could challenge those prior levels. So plenty to watch as it relates to Netflix. Don't get a whole lot of chart action on Netflix, but I wanted to bring that one up. Late last week, Rachel, we heard that we got a notification that Intel was placing a new CEO in the mix, and the market really liked it. And today you're getting a bit of a continuation move, a nice 7.5% pop. Noted today that the new salary for the CEO will be a base salary of $1 million, eligible for an annual cash bonus, target payout, etc., 200% of base salary. But as I see it, at this point, Rachel, the market seems to be pleased with this development, according to price action.
It does indeed. We had a little bit of a failed breakout there. It looks like last month or so. And then we have a strong bullish candle today, big green candle today, trying to move to that resistance level of that trading range that we've been in. So that's going to be the first level to really claim there around that $26. And then we'll have to see from there if we can close that previous gap. But this is looking a little bit like more of a reversal type rectangular pattern, because that's something that we typically see these ranges occurring at bottoms. They're typically a little bit of a reversal more than anything else. And we even reclaimed that 200-day moving average too with that gap above it. So we'll have to see if bulls can make a close above that $26 resistance level today.
That'd be great for a really nice development if it could. Obviously, that high trade here made us feel like maybe we need to pay close attention to that 27.5, but that was such a short-lived level. I'm not sure if traders are going to be as enthused about that one as they are getting through this ledge here, like you said, at 26.5. The white line up above is at about $33, and that's based on a potential measured move from the range we've traded in, which is 1850 to 2650, so about an 8-point scenario. And this is just a potential target zone that some traders might consider. It also coincides with this little bit of a gap zone from way back here on the way down. Don't allow historical price action to just get thrown to the side, everybody. Commonly, these levels still matter in the future as well. So was it resistance previously? Yes, it can be resistance again. So that could be something that we have to monitor here on Intel. But it's an improving look at a chart that has been really rough for quite a while, everyone. It has not been a good few years for Intel, as you can see, dating back to 2021. So trying to get off the mat, but it's not likely to happen in an expedited fashion. So as usual, stair steps up, Rachel, and escalators and elevators and sometimes elevator shafts to the downside, unfortunately. But it's a nice development nonetheless. Rachel, as always, love having you here once a month. I wish there was just more time to have you coach, you regional strategists with me. But I only get one of you each Monday, but I love having you. So thank you so much bringing the new charts to the table here today. I'm so glad we could share those with our viewers.
Yeah, love joining. Thanks for having me. And thank you everyone for watching. You all are so great.
I could not agree more. Love the community we got going here in the chat. Thanks to all of you for being here. As we've covered, plenty more to come from us today. Of course, Jeff's World coming at 9 a.m. Mountain, 11 a.m. Eastern. Big thanks to Connie Hill for managing the chat as well today. But as always, connect with us on X. Connie and I are available there. Connie Hill CS, Kevin Horner CS, and I think we're still waiting on getting Rachel access to X. But for the rest of us, please follow us there, everybody. We'd love to have that. And if you like today's conversation, hit that thumbs up button down below for us as well. We hope you have a fantastic St. Patty's Day, a great Monday, everybody. Look forward to seeing you again real soon.